Imagine a torrent of money, a digital flash flood, so powerful it sweeps away a financial giant in mere hours. $42 billion. That is the staggering sum depositors frantically pulled from Silicon Valley Bank, a name once synonymous with innovation and tech prosperity, in a single 24-hour period. This was not just a bank run, it was the fastest, most ferocious bank run in the annals of financial history. By the end of the second day, a 48-hour whirlwind of panic and digital exodus, the institution revered as the financial bedrock of the tech world, Silicon Valley Bank, had ceased to exist as an independent entity. Its market value, once soaring at over $40 billion, evaporated, and the total assets under its management, approaching $200 billion, were thrown into turmoil. This is the meticulously pieced-together true story of how a dangerous cocktail of perceived arrogance, critically weak risk management practices. This is the autopsy of Silicon Valley Bank, a deep dive into the Silicon Valley Bank collapse explained, for everyone to understand. We will explore the causes of SVB failure and the critical lessons this event holds for the future. The financial titan that forged Silicon Valley's dreams. Silicon Valley Bank, often referred to simply as SVB, was not just another faceless financial corporation. For decades, it had meticulously cultivated an image and operational reality as the bank for the innovation economy. Since its founding in 1983, SVB carved a unique niche, positioning itself as the indispensable financial partner for ambitious startups, powerful venture capital firms, and visionary founders brimming with disruptive ideas and even bigger global ambitions. SVB had, over 4 decades, transformed itself into an unshakable pillar of the global startup world, a symbol of stability and support for the risk-takers and dreamers. That was the perception, at least, until March 2023, when this seemingly invincible pillar crumbled with the shocking speed and finality of a house of cards caught in a gale. What precisely triggered this sudden and catastrophic implosion? Let us break down the sequence of events and the underlying vulnerabilities in simple, accessible terms. The SVB bank run explained in simple terms, as the internet discourse now frames this complex financial event. 3 foundational and fatal mistakes. The downfall of Silicon Valley Bank was not a single, isolated event, but rather the culmination of several critical misjudgments and operational failures. We can distill these into 3 principal errors. Mistake number 1, a profound disregard for interest rate risk. Did SVB consciously or unconsciously ignore interest rate risk? The evidence overwhelmingly suggests they did, to a catastrophic degree. The bank took a colossal sum, approximately $120 billion in customer deposits, money that belonged to startups and venture capital firms, and invested a significant portion of it into long-term government bonds, primarily United States Treasuries and mortgage-backed securities. Under normal, stable economic conditions, these are generally considered very safe, conservative investments. However, their safety is critically dependent on interest rates remaining relatively low and stable. Enter the United States Federal Reserve, the central bank of the United States. Faced with stubbornly high inflation that was eroding the purchasing power of ordinary citizens, the Federal Reserve embarked on one of the most aggressive series of interest rate hikes in modern economic history, beginning in early 2022. As interest rates rise, the market value of existing bonds, especially those with long maturities, falls. This is because newly issued bonds offer higher yields, making older, lower-yielding bonds less attractive. Suddenly, SVB's portfolio of safe assets began to bleed value. These investments were sitting on a mountain of over $15 billion in unrealized losses. Unrealized means the losses were on paper. They would only become real if SVB were forced to sell these bonds before their maturity date. This failure to manage Silicon Valley Bank interest rate mismanagement became a ticking time bomb. The bank had a significant duration mismatch. Its assets, long-term bonds, had a much longer lifespan than its liabilities, customer deposits, which could be withdrawn on demand. Mistake number 2, operating with the mindset of a startup, not a regulated bank. Most alarmingly, for a critical 8-month period leading up to the collapse, spanning from April 2022 to early 2023, Silicon Valley Bank operated without a dedicated chief risk officer. 8 crucial months. This is the executive primarily responsible for identifying, assessing, and mitigating all forms of risk to the institution. During this very period, interest rates were skyrocketing at an unprecedented pace, and global inflation was raging, creating a volatile and uncertain economic environment. Executive Officer Greg Becker seemed more preoccupied with cultivating relationships within the venture capital community and maintaining his high-profile public persona than with the less glamorous but utterly essential task of fortifying the bank's core operations. His background, notably, was not in risk management but in sales and client relations. Mistake number 3, aggressively lobbying against safeguards they would later desperately need. This mistake adds a layer of bitter irony to the SVB saga. Years earlier, in the wake of the 2008 global financial crisis, comprehensive banking regulations, commonly known as the Dodd-Frank Wall Street Reform and Consumer Protection Act, were implemented to prevent a recurrence of such systemic failures. However, SVB executives, including Greg Becker, actively lobbied lawmakers in Washington, District of Columbia, to relax some of these regulations for mid-sized banks like their own. They argued that institutions of SVB's scale did not pose a systemic risk comparable to that of the Wall Street giants, and therefore did not require the same intensity of regulatory scrutiny or the same stringent capital requirements. Their lobbying efforts were successful. In 2018, the Economic Growth, Regulatory Relief and Consumer Protection Act was passed, which, among other changes, raised the asset threshold for a bank. This meant SVB, with assets hovering around the $200 billion mark at the time of its collapse, was not subject to the most rigorous stress testing protocols mandated for larger institutions. Adding to the troubling optics, just weeks before the bank's collapse, in late February 2023, Chief Executive Officer Greg Becker sold approximately $3.6 million worth of SVB stock under a pre-arranged trading plan. While legal, the timing of this sale, so close to the bank's public admission of financial distress, drew considerable public criticism and scrutiny. When the situation deteriorated rapidly in March 2023, the very same executives who had argued against stricter oversight found themselves in the desperate position of appealing to the government for intervention and a rescue. The 48-hour freefall, a minute-by-minute account of the collapse. Let us meticulously walk through the condensed timeline of the largest bank failure in the United States since the collapse of Washington Mutual during the 2008 financial crisis. This was a bank run supercharged by the speed of digital communication and social media. Day 1, Thursday, March 9, 2023. The spark ignites the tinderbox. The beginning of the end started not with a bang, but with a seemingly controlled announcement that quickly spiraled out of control. Silicon Valley Bank quietly, or so it hoped, announced 2 critical pieces of news. First, that it had sold a significant portion of its bond portfolio at a substantial loss, realizing approximately $1.8 billion in losses. Second, to shore up its balance sheet after this sale, it was launching an emergency plan to raise $2.25 billion in fresh capital through a stock offering. This move, intended to reassure investors and depositors, had the exact opposite effect. It was a blaring signal of distress. Almost instantaneously, panic began to ripple, then surge, through the tightly interconnected tech and venture capital communities. Influential venture capital firms, most notably Founders Fund, began advising their portfolio companies, the numerous startups they had invested in, to withdraw their funds from SVB immediately. Founders, already on edge due to the uncertain economic climate, saw these alerts. Panic spread virally. Slack messages exploded with urgent queries and warnings. Tweets circulated at lightning speed, each one adding fuel to the growing fire. The VC panic and SVB's overnight collapse was underway, a stark demonstration of a digital bank-run phenomenon. Within a matter of hours on that fateful Thursday, startups initiated withdrawal requests totaling tens of billions of dollars. The bank systems, both digital and human, were simply not architected to handle this unprecedented velocity and volume of withdrawal requests. SVB's online banking portal started to glitch and crash under the strain. Telephone lines were jammed with frantic customers trying to get information or move their money. Night 1, Thursday, March 9, 2023, the long, anxious night. As Thursday evening bled into night, the anxiety within the startup world reached fever pitch. In private WhatsApp groups and encrypted Telegram chats, founders, chief executive officers, and chief financial officers of companies, both large and small, were grappling with the same terrifying existential questions. Is our company's cash, our entire operating fund, safe at SVB? Will we be able to make payroll tomorrow or next week for our employees? Is our access to our credit lines and other banking services about to be cut off? The glitches in SVB's online portal persisted, transforming acute anxiety into outright chaos. Attempts to transfer funds were met with error messages or interminable processing delays. The lack of clear communication from the bank itself only exacerbated the fear and uncertainty. For thousands of entrepreneurs and their employees, it was a sleepless night filled with dread. Day 2, Friday, March 10, 2023, the inevitable conclusion. By the morning of Friday, March 10, 2023, before the stock market even opened, the situation had become untenable. The run on the bank was overwhelming its ability to meet withdrawal demands. Regulators, seeing the irreversible trajectory, stepped in. The California Department of Financial Protection and Innovation officially closed Silicon Valley Bank, citing inadequate liquidity and insolvency. Almost simultaneously, the Federal Deposit Insurance Corporation, FDIC, was appointed as the receiver. This meant the FDIC, an independent agency of the United States government that protects depositors against the loss of their insured deposits if an FDIC-insured bank or savings association fails, took control of SVB's assets. The consequences were immediate and severe for SVB's clients. Startups, some of them with tens of millions or even hundreds of millions of dollars held in their SVB accounts. Funds essential for payroll, operating expenses, and growth initiatives suddenly found their money frozen, their access completely cut off. The most chilling aspect of this rapid collapse. On paper, just days before, SVB was technically solvent. It had assets that, if valued at their maturity date, exceeded its liabilities. The point of no return and government intervention. The true nail in Silicon Valley Bank's coffin came with its announcement on Wednesday, March the 8th, of the significant losses on its bond portfolio and its desperate attempt to raise $2.25 billion in emergency funding through the sale of new stock. This move, orchestrated with Goldman Sachs, was intended to calm nerves and demonstrate financial resilience. Instead, it achieved the precise opposite. On that single day, Thursday, March 9th, an almost unbelievable $42 billion was withdrawn or attempted to be withdrawn from SVB. To put this figure into perspective, that is equivalent to approximately $1 million being pulled from the bank every single second for 12 consecutive hours. It was a digital bank run of unprecedented scale and velocity. And so, by Sunday evening, March 12, 2023, the United States government made a rare and decisive move. In a joint statement, the Department of the Treasury, the Federal Deposit Insurance Corporation, and the Federal Reserve Board announced extraordinary measures. They declared that all depositors of Silicon Valley Bank would be made whole. Their deposits would be fully guaranteed and accessible, even those amounts that exceeded the standard Federal Deposit Insurance Corporation insurance limit of $250,000 per depositor. The contagious spread, the domino effect across the banking sector. The shockwaves from Silicon Valley Bank's collapse did not remain contained. The financial markets are an interconnected web, and fear, once unleashed, can be highly contagious. Within days of SVB's failure, another regional lender, Signature Bank of New York, which had a significant exposure to the cryptocurrency industry, also failed and was taken over by regulators on Sunday, March 12, 2023. It shared some vulnerabilities with SVB, including a high level of uninsured deposits. The stock prices of other regional banks across the United States plummeted as investors grew increasingly nervous about their stability, their exposure to unrealized losses on bond portfolios due to rising interest rates, and their concentrations of potentially flighty, uninsured deposits. First Republic Bank, another California-based institution with a similar profile to SVB, catering to wealthy clients and tech-focused businesses, found itself in the crosshairs. It experienced its own significant bank run, with depositors pulling out over $100 billion in the first quarter of 2023. Despite a $30 billion lifeline injected by a consortium of large Wall Street banks in mid-March, confidence could not be fully restored. First Republic Bank ultimately failed in early May 2023 and was seized by regulators, with the bulk of its operations subsequently sold to J.P. Morgan Chase. Crucial lessons forged in the fires of SVB's failure for startups. The sudden demise of Silicon Valley Bank, a trusted partner to so many, served as a brutal wake-up call for the startup ecosystem. Several critical lessons emerged, prompting a rapid re-evaluation of financial practices within the tech world. Lesson number 1. The imperative to diversify your banking relationships. For years, many startups, particularly those in Silicon Valley, found it convenient to consolidate all their financial activities, checking, savings, credit lines, venture debt, with a single institution like SVB, which specialized in their needs. The collapse starkly illustrated the inherent danger of this all eggs in one basket approach. Startups abruptly realized that institutional failure, however improbable it might have seemed, could instantly sever their access to all their capital. Consequently, many companies are now actively diversifying their banking, spreading their funds across multiple institutions. This includes opening accounts with larger, systemically important banks, exploring treasury management services, and sweep accounts that automatically distribute funds across several banks to maximize Federal Deposit Insurance Corporation coverage and mitigate concentration risk. Lessons for startup financial management now prominently feature treasury diversification. Lesson number 2. Cash is not merely an asset on the balance sheet. It is your company's oxygen. The SVB crisis brutally underscored how fragile even well-funded and rapidly growing startups can be when their access to liquid cash suddenly vanishes. Founders who had, perhaps complacently, assumed their substantial deposits were entirely safe and readily accessible, woke up to a terrifying new reality. Cash is the lifeblood of any business required for payroll, supplier payments, rent, and ongoing operations. Without it, a company cannot breathe. This experience has led to a renewed focus on robust cash flow forecasting, maintaining larger cash reserves where possible, and establishing contingency plans for accessing capital in emergencies. Lesson number 3. Rigorous risk management matters profoundly, even if you are not a financial institution. The downfall of SVB was, at its heart, a story of failed risk management. This has prompted startups to scrutinize their own financial partners much more closely, looking beyond convenience and specialized services to assess the underlying financial health and risk practices of their banks. Furthermore, there is a growing recognition of the importance of strong internal financial expertise. Companies are now considering hiring experienced chief financial officers or senior finance professionals earlier in their growth cycle, rather than viewing it as a role to be filled only when preparing for an initial public offering or a major funding round. Understanding counterparty risk, the risk that the other side of a financial transaction will not fulfill its obligations, is no longer an abstract concept but a tangible concern. Lesson number 4. The innovative tech world is not immune to old-school, fundamental financial principles. The Silicon Valley ethos often celebrates disruption, speed, and moving fast and breaking things. However, the SVB collapse served as a stark reminder that certain fundamental principles of finance are timeless and universal. Concepts like interest rate risk, duration mismatch, the risk arising from assets and liabilities having different repricing or maturity dates, asset diversification, and the psychology of panic selling are not just arcane Wall Street terms. As SVB demonstrated, they are existential threats that can bring down even businesses built on cutting-edge technology in the heart of Silicon Valley. The impact of Fed rate hikes on banks was a classic financial risk that SVB tragically underestimated. Closing reflections, a sobering case study in complacency and the fragility of trust. In the final analysis, the story of Silicon Valley Bank's collapse was not just a story about one bank's missteps. It was a story about hubris, about the dangers of unchecked confidence, and about financial systems that can be built more on fluctuating sentiment and confidence than on truly resilient, shock-proof foundations. It highlighted how quickly a digital bank-run phenomenon can unravel an institution in an age of instant communication. So the next time a founder, an investor, or even you yourself confidently states that your money is perfectly safe in a particular bank, it is worth pausing and asking a crucial follow-up question. Do you and does your bank truly understand and actively manage all the underlying risks? The reverberations of Silicon Valley Bank's 48-hour disaster continue to be felt. What are your thoughts on this? Did the Federal Reserve, the Treasury, and the Federal Deposit Insurance Corporation do the right thing by guaranteeing all deposits, even those above the insured limit? Was this, as some critics contend, a bailout in disguise, setting a problematic precedent for future crises? Or was it a necessary and decisive rescue operation to prevent a far greater systemic catastrophe and protect the innovation economy? The Greg Becker SVB role and the actions of figures like Peter Thiel SVB bank run continue to be debated. We encourage you to share your perspectives and insights in the comments section below. What lessons do you draw from this event? And if you are interested in understanding another massive financial collapse laid bare with clarity, be sure to watch our next detailed explanation. FTX, the alleged fraud of the century.